I'm here today with Stephen English, who's going to impart his wisdom to us investors on both the macro picture and how to deal with it. Good morning, Stephen.
Morning, Sammy. I'll certainly try.
So the stock market's been fairly volatile over the last 6 months and the macro picture's changing. What are your views?
The winds are changing for sure. To quote Bob Dylan unnecessarily, we were, in simple terms, expecting the exact opposite from a quantitative tightening environment to what we've seen from a quantitative easing environment. And in broad terms, we're of the view that QE was disinflationary. We think the collapse in yields has caused all sorts of unintended or perhaps intended consequences where you've seen marginal businesses allowed to survive. You've seen businesses that are highly loss-making, which are essentially just subsidising their consumers. So it's never been better for consumers. The consumer surplus, to quote the economic term, has probably never been higher. You look at Uber, which is hugely loss-making, businesses that are sending you food through the post, et cetera, et cetera. So it's caused an excess capacity, and we've seen this affect our own companies. This excess capacity that wouldn't have ordinarily been there is just bearing down on margins and making it incredibly tough to compete with a fairly irrational competitor where profit doesn't need to be front and centre, because there's so much liquidity awash and so many people are trying to get any sort of return whatsoever. You've seen a massive amount of flows. We've seen $7 to $8 trillion flow into private equity since the 08-09 crash. Much of that's coming from pension funds, which have to hit their 7 to 8 to 9% returns. So that's gone to businesses where you are awash with cash. You can raise cash quite easily. Uber's raised $21 billion, still not profitable. And that's a new dynamic for businesses that are listed where profit very much is everything, because they want to generate cash, they want to pay dividends to shareholders. So we were getting quite excited when QT was coming down the track, because we thought finally we're going to get some kind of cathartic purge coming through that's going to remove a lot of this excess capacity and allow returns not to go to supernormal returns, but certainly to edge up from the currently depressed levels that we see. And why I think it was disinflationary QE, what happens when you've got excess capacity is people are selling you more and more goods at lower and lower prices. They just have to get the top line moving and they're not really concerned about the bottom line. So if you remove that, which QT was looking like it was on the agenda until the Fed yet again has overreacted, in our opinion, to a bit of volatility at the end of the fourth quarter, that's changed things for now. But we do think that QT will have to come through certainly next year, if not later this year. So, and we'd actually welcome that, and our portfolio companies certainly would. I think that would allow them to make certain acquisitions, and it would help bring the price of those acquisitions to more sensible prices. So what happened last year, June, July, we had PEs go to 50, 60, 70 times on some of the growthiest stocks in AIM. That reached its apogee. There was a certain level of giddiness. Then we had Q3, the sell-off started. Then Q4, it became vicious, and there was a lot of gnashing of teeth and the end of the world type stuff. And that's rebased things for now, hopefully to more sensible levels. We don't see a return to those giddy sort of levels, but we do think that was largely caused by QE and people desperate in an environment where there's a paucity of growth, desperate to try and get any sort of return. And if you want one stat for how forgiving investors were last year, 80% of US IPOs were loss-making, and that's a record. So the market's never been more forgiving, or never, risk aversion is just out the window for the time being. You've got to listen to that. Generally, you take the opposite side to that trade, and the long term, we think that's where the payoff's going to be.
So what's your strategy to take advantage of this macro picture?
I think the strategy has to be multifaceted. There has been a paucity of growth. If you look at the stats, the amount of S&P companies that have been able to compound their top line growth by 15% or more for the prior 5 years has halved. So there's only around 100 companies in the S&P that has managed to do that. And that's been in a structural bear trend. And there's bigger issues at play. There's something going on with the climate. So you can delineate between the weather and the climate. And the climate's something structural. That's telling you growth, for whatever reason, is harder and harder to come by. And again, QE, I think, has just exacerbated a situation that was already starting to happen. That said, no one can time in my opinion, when is the time to jump from value into growth? So it's been a very lonely furrow that's been ploughed for value investors since 08, 09, and growth has just trumped everything. Those cycles, if you look at long term, they typically take 10 or 12 years to play out. So perhaps we're reaching somewhere near the end of it. It's not showing up in the relative charts, value versus growth as yet, but at some point, value will be very much on the agenda. And I see certain parallels between the .com, and hopefully we'll get onto that maybe in a bit more detail later in terms of the valuations that we're seeing in that sort of area. The parallel for me, and where you can do a lot of good for your portfolio, is look at companies that now have been overlooked, that perhaps aren't sexy, perhaps aren't growing their top line at 15, 20, 30%. But what they are doing is generating very strong levels of free cash flow. And relative to the share prices, so when we talk about free cash flow yields, we're seeing now free cash flow yields 10, 15, 18%. You take a step back, now you'd have private equity normally salivating at that, but because I'm concentrating on the AIM side, and the market caps are really too small for them to move the needle if they're doing a buy and build. But that's where I see tremendous value. Just as happened in 98, 99, these types of businesses were overlooked, but we see them as being the next leaders. And when growth does dissipate, when people realize the emperor's not wearing terribly many clothes, then all of a sudden these types of assets will be coveted again. In the meantime, you're getting very high dividend yields, so you're getting paid to wait in that sense. So we're bolstering our portfolio there. In terms of this altitude sickness, as I described last year, where valuations just got heady, we were scrambling down the mountain and trying to reinvest in much cheaper, I suppose you would call them traditional value stocks. That said, because no one can time this transition and changing of the tracks from growth to value and when value is going to outperform, I think it's incumbent upon you and doing the best job for your investors to have a foot in both camps. So I always like balance in life. I think that's good. So I do have still a decent position in growth-orientated stocks. I do think there's probably another 2 years of the mega trend there to play out. But when I say growth, I'm not talking about the exalted values that you're seeing elsewhere. It's more growth at a reasonable-ish price, but also then some deep value stocks and some in the middle that kind of straddling maybe a P's 14, 15 times, if you want to call it like that. You're getting a nice balance there. Also, you're getting a balance between some very micro cap, small stocks. Then we have slightly larger ones, and then some above $1 billion even. Some of that makes sense. And certainly in Q4, the amount of bargains that were cropping up on my screens, if you want to call it that, I don't use screens per se, but what's great about a sell-off and a liquidity sell-off, I thought Q4 was a bit of a head fake. I thought it was liquidity induced rather than any longer or more malign influence there. Is the most liquid stocks, because they're the most liquid, got sold the most. So sometimes it makes sense to actually revisit some of the larger cap stocks because they've been sold down the most because people were forced sellers. And we certainly saw some of that. So we took advantage of that as well. So you're all the time trying to make your portfolio as robust as possible. We think robustness is through diversification. And that's how we're looking to do that.
So for growth stocks, what PE are you prepared to pay at the moment?
Beauty is in the eye of the beholder. Never pay a 50 times, never pay a 40 times. The conundrum with investment, and this is why it's so difficult, and a lot of value investors will just almost sneer at growth investors as maybe being a little bit less intelligent than them who can crunch all the numbers. But for me, genuine growth investment is as hard, if not harder, than value investing. Value investing, you buy on assets and sell on earnings, is the old cliche. Growth investment, if you want a multi-bag, and I just finished reading the book 100 Baggers, which I recommend to everyone, and it's certainly brought a new tool to my toolbox. And perhaps I haven't been focused on brands with global scale and appeal as much as I should have done. But you need growth stocks in the portfolio because with the best will in the world, even the best value managers, it's such a hard discipline to have. Invariably, you're buying it and then it's gone down another 30%. You have to buy more. Then it's down again. You have to buy more. You're averaging down. Psychologically, it's so hard to do. Some of them go down and stay down and go bust. Value generally works because you're buying risk. They're quite risky companies. So you need economic growth to come through and economic growth to be strong to get them out of that situation. A bit like a plane, before it hits the ground, it can turn up and the economy can help them with that. But you do have losses on that side. So to offset that, you need stocks with the ability that can go up 1, 2, 3, 4, 5-fold. If you own them long enough, 20, 30 years, you can get those fabled 100 baggers. So I do think they're an absolutely necessary part of the portfolio, which is a long preamble. You asked me the question, what PE would you pay? I do pay PEs of up to 30 times. If you want a stock that can compound the most, that stock should always look expensive if it's doing things right. It should never be cheap. People in life, when they're shopping, they get the difference between price and value, but seemingly when it comes to investing, it's more difficult. We don't sell many DVDs anymore, but when we did, if you ever went into a BP or an Esso garage, you go rummaging around the DVD bucket, and there'd be some DVDs that were marked down from £10 to 50 pence, and 50 pence is still 50p too much for them because they're rubbish. Whereas a growth stock, at 30 times, it sounds painful. You may get some wobbles on the way. It's like a bucking bronco. It will try and throw you off. It tries to throw off the weak hands all the time. You may have big drawdowns of 30, 40, 50%. Amazon's had many of those on its heady ascent. But the best stocks, I will say again, you have to pay up for them. Ideally, you want to pay 20 times. But if you've got a stock that you have a view on that compound and reinvest its excess cash flows into at the same level, can compound 20 or 30% per year, even if you're paying 30 times, that's going to look like a bargain over 5 years. It's going to look like a steal over 10 years. Now, the difficulty is trying to get those ones that can sustain that very high level of compounding. So yeah, 30 times, look, we prefer it at 20, we prefer it for less than that, but I take it as a sign of confirmation that it is actually a high quality, long-term compounding business.
So why wouldn't you be overweight in growth stocks? They seem the place to be.
They do, until the bogeyman whacks you over the head and you have a profit warning, or for whatever reason there's an exogenous shock, or it's gone ex-growth, and then you are in a world of pain. There's very, very few companies that can sustain long-term compounding ability. So if you're too much into growth, what you're also doing is you've stylistically gone to one church. It's very dogmatic. I actually see value and growth as two sides of the same coin. Both of them, last time I checked, are trying to buy something for less than its intrinsic value. But to be 100% growth when you're on one style, there's wider cross currents that affect you. So a lot of people just focus on the fundamentals of the business, which is fine, but there's all sorts of buffets in terms of share price can be buffeted by myriad factors. One of them is rising interest rates. So there's a technical aspect in terms of growth stocks. I'm not getting too technical on it, but like a very long duration bond, they're very, very sensitive to interest rate rises. So very, very likely, even if the company still hits its figures, you'll just endure or have to endure a derating in that stock. That's if interest rates go up. Interest rates are always surprising people. The surprise is how surprised they are all the time. That's the only surprise from it. So interest rates are cyclical. Who knows when inflation does rear its ugly head again? Personally, I think that is the denouement to this whole massive monetary experiment that we're undergoing. So you want stocks that will do well in a inflationary period. You want stocks that will do well in a disinflationary period, stocks that will do okay, stocks, and I say okay because it's not a good period to be in, but in a deflation period, you certainly don't want debt on your books if you've got deflation coming in. But I never want to be overweight any one thing. It comes back to this balance. Diversification it's an explicit recognition of ignorance, and proper diversification means hating a part of your portfolio all the time. It'll be a different part of the portfolio that you hate, but if you are comfy with every single stock in your portfolio, you are not diversified enough. And this is the struggle for a fund manager, viewing that blend. I describe it as brush strokes, a mosaic you're trying to build up. In previous presentations I've done, I've zoomed in very, very close to Van Gogh, my favorite artist. his Starry Night painting, the brush strokes when you zoomed in very, very close to make no sense whatsoever. When you pull out as a whole, and this is what a portfolio is, individual line items in the portfolio might not make much sense, but when viewed as a whole, you can see, well, actually, that part will do well in this environment, that part will do well in this environment, because there's no point in forecasting the economy or where it's going to go. You want to have a foot in both camps, and it comes back to this robustness thing. If value has been in a 10-year bear market, you don't want to be 100% value. You certainly didn't want to be. You've lost so much money, and the opportunity cost has been huge. Now, if growth will go into a similar 10-year bear market at some point, but there's still a place for a smaller part of the portfolio. Since 08-09, I have been slightly biased towards growth, but more recently, I'm starting to recalibrate and become more balanced with value and growth again.
And you say you should be uncomfortable with one part of your portfolio. Which part of your portfolio are you uncomfortable with?
Gee, there's too much of the portfolio at the moment. It's the most profitable investments are those that have, sorry, pardon the expression, but an ick factor. It's when you buy them and you're like, there's something up with them. They're tainted. They're ugly. They've had issues. So I suppose it's more those that are exposed to a restructuring story where we do see improvements going along the line. We are seeing early evidence of that, but there is still an element of doubt in there. But the narrative has to be poor when you buy an investment if you want to make the most upside. Consensus is consensus, and it's very often right. The problem is you don't make that much money when it is right. So I think it was Charlie Munger who looks at it from an expected value point of view, and it's not the frequency of how often you are correct or incorrect that matters when it comes to investing. It's how much money you make when you are right and how much money you lose when you are wrong. So what parts am I uncomfortable with at the moment? Well, I have deliberately now overweighted the portfolio to the UK, to domestic sales. 2/3 of the portfolio is coming from domestic sales. The Market Wizards books are absolutely fantastic by Jack Schweiger. It got me onto the fact that equity markets are very, very poor at correctly pricing in on a probabilistic measure a known unknown. And what bigger known unknown, it's getting Rumsfeldian now, what bigger known unknown have we had than Brexit? So you look at the stats, ever since Brexit was announced, we are now very, very under-owned by foreign investors. So there's been a flow of money effect. We are now the cheapest developed market in world equities, which is a fantastic starting point to be. And we're overweight as a firm, we're overweight domestic companies. Why do stock markets overreact, and why are they very, very poor at pricing in known unknowns? It's because I think it's the fear of looking like a fool effect. Everyone knows Brexit has the potential to be negative. Better to sell, and then we'll revisit things when things settle down. Now that's great, but it's quite a glib answer in the sense of when things settle down, you're going to pay 30, 40, 50% higher than you could have done. And at some point, because of that fear effect, people are indiscriminate at the price level they are taking when they exit the investment. They're no longer bothered about the price in that sense. It's just get me out, get me out, get me out at any cost. So that causes this elastic to overextend. So we have had to listen to that valuation, and we've had to go into these stocks, even though the negative narrative is there, because we see, and it comes back to the Munger and his expected value approach, this very often it's better to look at it on what's the probability and what's the loss on that probability going to be, but what's the probability of an upside and what's the upside if that less likely event happens. So a lot of these stocks now, even if we get a hard Brexit, I'm not seeing that much downside risk from them. If we do get a Deus Ex Machina intervention from something happens, we get some sort of resolution, then you're looking at very, very strong upside. So it's an asymmetry that I'm feeling in certain stocks. So it does have the ick factor. People are always, well, a hard Brexit, that means a recession, recession, recession. I would argue that some of the stocks are already priced for a deep recession, not just a recession, a deep, deep recession, something rivaling 08-09. So some of them, perversely, it doesn't matter if we get a recession, as long as it's not a deep recession. Because when you price one thing, and if the expectation is different from the reality, that's how you make money. So It does have an ick factor. It's not a comfortable place to be. A lot of people are shunning these stocks, which just contrarianism is a lonely, lonely place. But I can't ignore the values.
And what's your timeline?
As long as it takes, in some sense. Some stocks I'll put in there with a view to hopefully owning them for 5 or 10 years. Others are going to be more on an 18, 24-month view. The special situation turnarounds, they're on the shorter term time periods. Most investments, so I want to be holding these for 5, 10 years plus, unless the news flow changes that causes me to sell them. I think with turnarounds, you should turn around from most of them because most of them are rubbish. And if I can give one piece of advice on a turnaround, just while we're talking about them, is just when the proverbial hits the fan, wait 3 years and then revisit. It takes that long for people just to completely loathe and detest the share because you've had repeated warning after warning. You've had a new team come in. They're going to have to sack the old car because they don't buy into the new vision. Cost cutting's coming through. Look at it after 3 years. It's very, very painful because people just get bored with investment. So it shakes out the weak hands again when it comes to turnarounds. My bigger worry though is because we are so under-owned and we are so hated as an asset class by foreign investors, we're going to see companies getting taken out on the cheap, opportunistically. And there's a febrile atmosphere with investment at the moment, and I think it manifested in particular in Q4. We're seeing, when you see a piece of good news or when we think we're getting close to a Brexit resolution, my screen is awash with green moves on the up. People are just so close. They want to buy the market in the first instance when they've got some sort of resolution. Then we get a bit more negative news flow, back to red again. But it's just showing you there's a huge amount of weight of money effect to come into the market. So you want to be in ahead of that flow effect. Flows move factors in that sense. But the worry is, and we've seen it with Manx Telecom, I'd be apoplectic if as a shareholder because that price just looks far too cheap that they're getting taken out by private equity. Private equity, to be fair to them, have seen the cash flows from that business and they've seen the valuations and they are going to reap that now. And that's public markets don't do a good service sometimes. When there's a known unknown in particular did terrible. So there's a certain worry that where the sterling dollar and sterling euro rate is as well, it just makes it cheaper still for foreign buyers. That's what I'm more concerned about. And we've seen it within Marsat as well. That's getting taken private. Apax, who used to own it, 2 telecom companies in particular, and telecom has been in an awful bear market. Manx is funny because in Q4, I was getting very interested in it. They've got a brilliant piece of technology for the hard of hearing across the mobile phone network, but they just got too cheap and I was salivating at this, and then they started to rock it and I was saying, what's going on here? And then the bid came out, the premium was quite skinny because the share price already started to move, but you take a step back and they've got a bargain. And I think they've rolled over far too quickly, the board, and accepted our offer. But that's going to happen more, and that's fair enough. So as a good strategy, and what I'm trying to target now is, because you've got this weight of money in VC and private equity land, a rare event that the private multiples are higher than public market multiples. Normally it's the other way around because there's a price for liquidity. So normally public markets trade at a premium, but it's not the case. So much money has flooded into the private equity arena. They are desperate to put that to work. So a good strategy, and what I'm trying to identify, and it goes back to these high free cash flow companies that can service debt for private equity. Sometimes a company's worth more under private ownership than it is in public ownership. It shouldn't be, but it actually is at the moment. So if you can find companies that are on EV/EBITDA multiples, stick your 30-40% takeover premium. After that takeover premium, if that EV/EBITDA multiple is still below where private deals are getting done at, that's a good place to be. Very good place to be. And I'm not saying for one instance buying a stock because you think it's going to get taken over. That's an awful strategy. But what it does do, there's no harm in spotting a sector that's consolidating because it's consolidating for a reason. You can spot others in there. What it does do is it just limits your downside, and you've got a free option on any sort of corporate activity. And you've also got a free option when things move on. Brexit will reach some sort of resolution. You'll get a re-rating eventually.
So you're talking about telecoms. Which other sectors do you think are ripe for that at the moment?
Anything it always, especially with private equity, it always comes back to free cash flow, always. So there's a few sectors like that. I'll give you an example, one we've bought recently, Property Franchise Group, talk about free options. You've got a free option on housing volumes recovering. Essentially, the majority of the earnings is covered already by their management fees that they charge tenants. It's a franchise model. It's very capital light. It's a 6% dividend yield. Their free cash flow yield is in double digits. This is just fantastic. So you could repay the entire market cap after 10 years, essentially, just with the free cash flow. And that's before you lever it up. There's net cash on the balance sheet as well. And just as an aside, I hate debt at the best of times, but perhaps because companies are so vulnerable to takeover, perhaps it's better to take a turn of debt rather than be awash with cash, and then it just makes it easier for private equity to come in and gear your balance sheet up. So maybe it's a defensive measure for the time being, because it's better to still be around in 5 or 10 years, because I'll make much more upside. I don't want to take a 30-40% premium, takeover premium, because I think there's 100% over 3 years, so why would it take 30-40% in the near term? So there's that one. There's support services. There's mission marketings on a free cash flow yield 15 to 18%. It's got a bit of debt on its balance sheet, but it's recovering very, very strongly. It's paying that debt down very, very quickly. There's a very entrepreneurial culture there, and they're finally starting to integrate their various businesses together, so there's a cost-saving story as well. Or you've got Hydrogen, which is another recent addition to the portfolio, which is the specialist recruitment firm. Again, that's gone to net cash on the balance sheet. Dividends coming through. There's a series of upgrades, but the free cash flow yield, again, it's double digit. And you don't often see double digit free cash flow yields. Sometimes you see them because the market's saying, well, the free cash flow is just going to decline and decline and decline. But that's not the case. These are going to at least maintain this cash flow. So it's not one sector. Certainly on AIM, it isn't one sector at all. But I would focus on those highly, highly cash generative companies now. Very often you're getting paid to wait with the dividend yields as well.
So moving on to tech, and we've been in perhaps a tech bubble, certainly a tech revolution. Where are you at with tech, and where do you think the market sits?
I think we're in a bigger bubble now in tech than we were in 98, 99. It was the CEO of Sun Microsystems at the zenith of the euphoria of tech, when his company was trading on a price to sales of 10 times. This was a couple of years after the event. I'm not sure he was screaming it at the time when he was CEO, but he said, what were you thinking to investors? I was on 10 times sales. For you to get a 10-year payback, I would have to pay 0 wages to my 39,000 employees. I would have to pay 0 taxes to the Treasury. I would have a 0 direct cost of sales. I would have to pay 100% of my sales as dividends. You would have to pay 0% tax on those dividends. What were you thinking to get a 10-year payback? If you look today at the US software tech, a lot of them are cloud companies. They're trading at 14 times EV to sales, 14 times EV to sales, not EBITDA sales. So he was bashing them for 10 times, and now we're at 14 times. And again, I think this comes back to this paucity of growth. It's a bit like a drying riverbed where you've got few pools and the fish desperately having to cluster in what liquidity is left because there's nothing else out there for them. And you've seen this with tech. I'll give you another stat which almost fell off my chair, and it was the 6 tech stocks in the US. It's a new acronym for me, FANMAG. So Facebook, Amazon, Netflix, etc., etc. Their combined market cap now is $3.5 trillion. 6 stocks are worth $3.5 trillion. There's only 2 stock exchanges in total that are bigger than those 6 stocks. The obvious one is US, 21 trillion thereabouts, and Japan. So if these were an stock exchange, a whole index, they would be the 3rd largest stock exchange in the world, 6 stocks, which tells you everything. And if you look at the stats, top companies don't tend to sustain as the biggest companies 10 years down the line. If you look at them, they're always reconstituting, they fall away, mean reversion, etc., etc. I don't think these stocks are going to be worth $3.5 trillion in the future. It's just not going to happen. And that tells you everything. And because rates are so low and because pension funds have to hit their returns, because so much money is flooded into VC and profits aren't a problem, we are not demanding profits today, you've had this euphoric rush into tech. So I see it as much bigger, a much bigger bubble than we've ever seen in halcyon days of tech. So just be slightly nervous if someone's trying to hawk around a tech investment that's relatively cheap, because it's only on 7 times price to sales. It's still ridiculously expensive. So relative valuation, you still got to look at absolute values. For me, tech doesn't make much sense, but that has pervaded also into the wider stock market. And I think there's a bigger issue here and something to be more concerned about for wider companies is profit margins are now at record highs. 13% is the average profit margin for the S&P 500. Now, if you look at the long-term, decade-long-term charts, you will see fairly defined cycles when it comes to profit margins. The normal or normalized or average profit margin is 8%. So everyone says US stocks, yes, they're a tad expensive, but actually on PE terms, there's much more to life than a PE, but on PE terms, they're pretty reasonable. They're not too far away from the average 15 times PE that they're traded at. But that assumes that you can sustain a 13.5% profit margin. Now, there's all sorts of reasons why structurally companies perhaps are higher margin than they were in the past. They're much less capital intense than they were. Margins are higher in tech. Tech is a bigger part of the index because they've done so well. There are structural reasons why, but there's also structural reasons why there is a mean reversion element to this. To give you a stat, if you kept the PE at 15 times on the S&P, but you had a normalization of profit margins back down to their long-term average of 8%, your downside would be 60% to the index today, 60. So that's something to have in the back of your mind is, while it doesn't look that expensive, it assumes that profit margins can sustain. Now, you're seeing one of the reasons why is that they've taken a disproportionate part of the pie versus labour. Workers have been in a terrible place ever since 08-09. It's been drudgery for them. You'd never guess it by looking at the stock market. And this is the difference between the economy and the stock market. Often they're hardly related at all. Sometimes they go in the complete opposite direction. So we've had Wall Street has been trumping Main Street. I actually think the worm's going to turn back to the man on the street, woman on the street, where Main Street's going to do better than Wall Street. You have to suppose that unions now are going to get stronger. There's been too much concentration allowed within industries, which has allowed them to charge supernormal profits. It's allowed them to bear down on labour. Unions are less powerful now than they were. But you're seeing this rise up against that with populism. QE poured petrol on the fire from an inequality point of view. The rich, the top 1% or the top 0.1% just got so much richer, while the man on the street has suffered in real wage losses, and productivity is an issue as well. It's not been a good time for them. So you push back against that, and I am worried that there is downside there. So I do see a huge bubble in tech. I also see some opportunities, certainly on AIM, but in terms of the big mega caps, I wouldn't want to be overweight for the next 10 years. So
what's your opportunity on AIM in tech?
Tech, I like companies that dominate their niche. When you look at relative market share, if you've got 4 dominant providers in an industry and they've all got similar sorts of market share, it's almost a mutually assured destruction policy. They're having to invest a lot of money just to stand still. What I much prefer is to have an incumbent that dominates their niche and it's got a strong focus, and their software is better, faster, cheaper than anyone else, to their number 2 or the number 3 and the 4. What that means, if they're dominating, they've got much higher sales, much higher profits, they've got a much higher R&D budget, their product that's already the best in class gets better and better. More and more clear water gets put between them and the number 2 and the 3 and the 4. And this virtuous flywheel starts to spin faster and faster and faster. So I like Castleton Technology in that respect. They are a social housing provider. They have just completed now a full suite of products, and they are targeting both the higher end of the market, and they've also got a more value end to smaller housing association operative. They're even so advanced they can plug into an Alexa, where a tenant can shout something to Alexa, the boiler's broken down, and then it'll feed through into the CRM systems and housing association. It's just best in class, because that's all they're doing is housing association software. You can't beat Focus. I always remember the time when Match.com, the dating online website operative, fell because Facebook announced that they were getting into online dating. And it shook my head, because Facebook have got no focus whatsoever on online dating. Match.com, they live and breathe it. They've got all the data going back decades, and they've started to recover very nicely. So you can't beat Focus when it comes to that. I also like opportunities that have the potential to go exponential, if you want to call them rocket ship stocks. And I say potential because you do need these in your portfolio to offset losses elsewhere in your portfolio. So I've had a company called D4T4 in there for quite a while. This is a company, I think their technology is best in class. I think in terms of the wider issue of what it's serving, it's kind of the marketing to one. It's playing that theme, and that's where the world is now getting to. Everyone's getting very, very personalized marketing messages, and it knows what you've been looking at online, and banks are using it a lot. Banks are actually saving hundreds of millions of dollars by using D4T4's technology. So the payoff is ridiculously high for them. And what's happening now, I think this flywheel is starting to come through. Once you get a big customer, it's called referenceability. You've got a contract that you can then reference to another big bank. Look at the amount of money these save. Okay, we'll have a bit of that. And you look at the share price now, they've just announced a flurry of new contract wins. They made a key hire for me in the US. I think he's an exceptional salesperson, and I think he's now driving it to the next stage. So they're the ones that excite me. And as a PA position, it's not cash generative enough at the moment, but I do like Cloud Call. I think that's a fundamentally misunderstood stock. And I think, again, this is where public markets need to maybe educate themselves a bit more and become less myopic on the today and more focused on the years ahead. When it comes to software, if you've got a company that can generate a lifetime value that is 3 times or more the cost of acquisition of that customer, you should be plowing every single pound that you've got into acquiring as many customers as possible. Cloud Call's lifetime value is 7 times their cost of acquisition, well above 3. 3 is the benchmark. Anything above 3, you can argue you're under-investing on your marketing and sales function. So what it does today, though, is because it's an annuity stream, you're taking the cost today, so your losses get bigger the more customers you're signing up. But what you're doing is building up a bigger and bigger base of recurring revenue, which is really high margin stuff. But unfortunately, because it's cash flow negative, public markets hate cash flow negative companies. It's actually good when you inflect from negative to cash flow positive. But there is a time and a place for these types of actions. A bit too soon for the wider IHT strategy that I run, but certainly PA, I think Cloud Call is very, very interested. And when we say price to sales, they're on 2.4 times price to sales, not 14 times as their bigger US peers are.
But don't they keep pushing back their cash flow positive time when they're going to achieve that?
They do, but that's almost the point, because that is a fantastic use of their money today, because they're getting a 7 times payoff on acquiring every customer. So it seems at first glance a negative, but it's actually a positive, because you're building a big recurring annuity stream. So it's actually getting bigger. It's actually becoming a more sustainable business. Unfortunately, they don't have bottomless pockets. I think they should have raised more into placing than they did, but I think the product is very, very good indeed. And I think it's the right strategy. And I haven't spoken to the company directly, but I would be telling them to carry on doing exactly what they're doing. Yes, stock markets fixate with things moving to the right, but that's only the here and the now. I think there is an overly short-term focus with public markets in particular, and perhaps that's why, part of the reason why we're seeing less companies coming to the public markets, which is another issue. And last year, there was more take privates than there were IPOs in the US for the first time since 2008, which is telling. I think that is telling. Albeit I think it's going to reverse pretty quickly, because you're seeing all these unicorns now bolting out with a stable door, trying to get to the auction pen and selling themselves rapidly. You're seeing Lyft has just listed today, loss-making, Uber. It was funny, they were trying to you beat them to the punch. So Lyft now has listed first, much to the chagrin of Uber, because when it comes to stock options, their tie-up and lock-ins for their staff is going to expire before Uber. And it's very, very important to be first to the post, so you can just start selling well in advance of Uber, because they will start to mirror each other in a valuation perspective. But these fabled unicorns I look at a lot of them and I'm just seeing a donkey with a carrot stuck on its head. I'm not seeing a unicorn at all. And I think the glue is actually starting to fail and the carrot's in jeopardy of falling off, and that's why they're desperate now to list. So everyone was saying there's a cyclical argument. Oh, look at public listed companies, they're all staying private for longer. They are up until a point, because there's been so much money with VC, it allowed them to stay private for longer. But at certain points, so Lyft's 20 billion plus market cap, Uber's going to be $100 billion market cap. These VCs need an exit eventually. You can't eat your IRRs if you don't realise your returns eventually. And only public markets are big enough to be able to provide the liquidity for 100 billion market cap. So Lyft, Pinterest, Slack, Uber, Airbnb, they're all slated now to IPO. So all of a sudden the narrative's changed. These tech boys, we don't need the listed markets. You know, we can do what we do. They only stay private because they could. In the past, there wasn't that wall of money that allowed them to raise the funds on a series A, B, C, D, E, F, G, all the way up to Z. But there is now, for the time being, until they get too big, and then we love you again, public markets. But it's funny, everything's cyclical. In life, everything's cyclical.
Stephen, thank you very much indeed for your time.
You're welcome. Thank you for coming in.